Holy smokes everyone, central bankers' worst nightmare just happened. In this video, I've got some absolutely insane charts to show you, and this has never happened in US history, because it seems like the central bankers have won the battle on inflation, but they may be just about to lose the war. So what exactly are these charts, and why is it the worst in US history? Well everyone, that's exactly what I'm going to discuss in today's video, and I also want to thank today's video sponsor, FE Battery Metals. That's stock ticker FEMFF, but more on them later. So everyone, without further ado, let's get straight into the news, the facts, and the data. Well, look at this everyone. This is absolutely massive, and I don't think many people understand how bad this really is. So look at this chart of the day. US treasuries are on track for their longest stretch of losses since 1787, and really since records began in the US. So that's absolutely right everyone. What we are witnessing right now in the bond market is completely unprecedented. But I've got much more information to show you later in the video that could prove the bond market is about to be dealt another massive blow. So go ahead and bring up this chart here everyone and listen to this. Never in the history of the US Republic have US Treasury returns fallen 3 years in a row. That's exactly right everyone, and you better wake up and pay attention right now, because what caused the banking crisis? It was their bonds on their portfolio and their mortgage-backed securities on their portfolios absolutely crashing, and then when everyone wanted to pull their money out, they couldn't sell the bonds and the mortgage-backed securities for the price they paid for, so they faced huge losses and they didn't have enough money to pay depositors fleeing. Well, if bonds keep on crashing like they are now, it could be about to get much worse, and we could see more banks go under. So as we can see on this chart here, in 2023 year to date, third consecutive year decline, and 17% decline in 2022 was the worst since 1788. So Bank of America warns the pains in bonds have been driven by aggressive interest rate hikes from the Federal Reserve. Since March 2022, the Fed has hiked interest rates 11 times, bringing the effective funds rate from 0 to more than 5% today. As interest rates rise, bond prices fall, which is why bonds have performed so poorly. So everyone, when we're witnessing the worst bond market crash in 250 years, do you really believe the officials just say that the economy is fine, there's no need to panic about the banks, there's no need to get your money out, don't worry, just listen to the news we're putting out there in the mainstream media? Or should we really start looking under the hood and figure out what's really going on in the financial system and the economy? Well, people, what caused this bond market crash? It was interest rates going up. And what causes interest rates to go up? Inflation. Have we got any more information that inflation could be about to get much, much worse? Well, yes, we do. Well, look at this, everyone. Market expert says $100 per barrel of oil is in sight as China takes to the skies. So what we saw in 2022 and the first half of 2023 was China's economy completely crashed. They'll still locked down. They weren't reopening. But now that China's starting to reopen and they're starting domestic travel and international travel, well, that's going to mean a lot more demand for oil, and we could see oil, like he talks about here, hit $100 per barrel. Now again, why as investors should we worry about oil? Well, that's a fuel for the economy. So if oil, petrol, gas prices, diesel prices go up, everything else is going to come much, much more expensive. So he says here, you're going to have some big increases in jet fuel demand, probably something like 500,000 barrels a day of jet alone in China. Brent oil futures have already surged by almost a quarter since late June, as deep supply cuts by Saudi Arabia and Russia and other producer nations scale back output, and wider financial markets price in less risk of recession in key economies like the US, and Brent is likely to trade in a range of between $90 and $100 by the end of the year, Ross said, and it stood just below $89 on Friday. So we'll go ahead and bring up this chart here. We can see here the violent rebound oil is doing right now. So in the fourth quarter of the last financial year, Chinese domestic flights were about 75 to 80% of the 2019 pre-pandemic levels, and now they're already back to 110%. International has rebounded from very low levels to about 75%, but that's not the only catalyst that could send oil surging again. So there's going to be substantial stockpile draws if OPEC extends 1 million barrels a day curbs. G7 nations will raise the cap on Russian oil prices if that's what's needed to maintain the flow, and product markets likely to be tight due to a large number of unplanned outages this year, ranging from freezes in the US to strikes in France to issues caused by the heat wave. So everyone, this is just simple supply and demand economics. There's a lot more demand with oil, with the world reopening, with China reopening, opening with the economy doing better than expected, but this is also a double-edged sword because that is going to mean there's going to be more rate hikes and more losses for the bond market, which will mean more losses for the banks and could cause another financial crisis. And guess what? We're already seeing these higher oil prices already flow into gas and petrol prices. It's Labor Day as I'm recording this video, and I don't know if you notice, if you're driving around on Labor Day, you're probably seeing gas prices at record highs. So look at this, everyone. Labor Day weekend, gas prices are near all-time highs. The record high for gas prices during the week leading up to Labor Day was set in 2012 at $3.84 a gallon, according to CNN review of federal data that goes back to 1990. But current prices are just shy of that. The national average for regular gas is at $3.86 a gallon on Thursday, according to AAA. Now, here's the unusual thing. Normally, prices tend to trend down lower in summer, but they're doing the reverse right now, which is very bad news for the central banks. So normally prices at the pump cool off as summer winds down, not this summer, for a variety of reasons, including OPEC holding back supply and extreme heat that has messed up with refiners. Gas prices have steadily increased this summer. The national average price for regular gas stood at $3.58 a gallon on Memorial Day, the unofficial start to summer. Now, this is also very important for consumer confidence, because once consumers start to see gas prices and petrol prices going up every single day, that starts to lower their consumer sentiment. And we're already starting to see this in the surveys. So consumers are very sensitive to increase in gas prices, in part because of how visible they are. Many people view the price of gas as a key economic barometer. In fact, the Conference Board blamed the recent uptick in gas prices for driving down consumer confidence in August. The average consumer isn't thinking about it in inflation-adjusted terms, said Lowe, because the price is shown at every corner. People see the price and think about what it used to be. So okay, the bond market is tanking, oil and gas prices are surging again, but we also have some huge key charts for commodities that could see inflation surging again. So look at this, everyone. Natural gas. Workers at Chevron's liquefied natural gas export plants in Australia are planning to strike for up to 11 hours a day beginning Thursday, threatening to disrupt production in one of the world's biggest producers. So unions will start a week of so-called work stoppages at the Gordon and Wheatstone downstream plants, according to documents seen by Bloomberg. Shorter strikes are planned at the Wheatstone platform facility, the document said. The plants made up roughly 7% of global LNG supply last year. And as we can see with this chart here, the price is steadily increasing. Next, diesel is increasing as well. So retail diesel costs are rapidly rising in the US much earlier than usual this year, potentially inflating the cost of farming, heating, trucking, and construction. So again, this is how I say this is the fuel for the economy, and it's going to make everything much more expensive. If farming gets more expensive, food prices are going to go up. If heating gets more expensive, well, utility bills are going to go up. If trucking gets more expensive, well, consumer goods are going to go up. And construction, well, the housing market is going to go up as well. That's a cautionary flag, as just about everything that makes up the economy runs on diesel in some way. The culprit? Excessive heat partly led to a slew of refinery outages across key regions in the US Gulf Coast and Europe. You know what I think would be a good solution? Just create more refiners. But no, they're closing them, and the US hasn't actually built a new refiner since 1977. After a relatively calm start to 2023, large daily price gains have been the norm since mid-July, leading to a 9.3% surge in August and the first back-to-back monthly advance since last summer. So again, everyone, as we can see with this chart of diesel, we are seeing a sharp reversal here. Next, power. Again, all businesses that have power bills, if their power bill goes up, they're going to have to increase costs. So with Atlantic hurricane season heading into its most active period, it's a good time to take a look at Florida's power market, which often takes a hit from natural disasters. So over the past 2 decades, natural gas-fired generation has accounted for an increasing share of the electricity mix, from 31% in 2002 to 75% last year. The shift has come at the expense of coal and oil-fired generation, which made up just about 6% and 1% respectively. Of the total in 2022, looking ahead, planned plant additions and retirements will continue to change the generation mix in the Sunshine State, with solar expected to grab a growing foothold. And as this chart, everything is getting more expensive as well. But everyone, like the saying goes, during every crisis, there's always huge opportunity. And what I think is going to be a huge opportunity coming ahead for this commodity boom, for a risk of inflation surging again, for a risk of central banks causing a market melt up, well, that's in the metals. And a huge metal that has a lot of potential right now is lithium, and Bloomberg believes this as well. So listen to this, everyone. Spot prices of lithium carbonate, a refined form of lithium, have been on the wild ride. They surged to a record in November as efforts to decarbonize the transportation sector boosted consumption before plunging this year as supply pressures eased. Even so, the appetite for the indispensable metal in the making of electric vehicle batteries is set to grow. Chile, host of a lithium forum on Wednesday in Santiago, has the world's largest reserves and is number 2 supplier after Australia. So demand for the metal, listen to this, will be 16 times the total lithium in use today by 2040, potentially outrunning supply by more than 40%. So we can see with this chart here Chile's role in the global lithium market, as well as Australia, the rest of the world, Argentina, China, and the US. Now also CNBC has put out a report that there's going to be a worldwide lithium shortage that could come as soon as 2025 because the demand is about to go insane. We expect an average of 20.4% year-on-year annual growth for China's lithium demand for EVs alone over 2023 to 2032, the report stated. In contrast, China's lithium supply will only grow 6% over the same period, BMI said, adding that the rate cannot satiate even 1/3 of forecasted demand. Now, China is the world's 3rd largest producer of lithium, which is an integral element in electric vehicle batteries. The world produced 540,000 metric tons of lithium in 2021, and by 2030, the World Economic Forum projects that global demand will reach over 3 million metric tons. So again, everyone, simple economics 101, there's huge amounts of demand for lithium, especially with this huge push for renewables and electric vehicles, whether you like it or not. This creates a huge investing opportunity. There's not going to be enough supply there, and there's going to be so much demand, especially from governments as well. According to forecasts by S&P Global Commodity Insights, EV sales are set to reach 13.8 million in 2023, but will subsequently proceed to skyrocket by over 30 million by 2030. So everyone, I don't know about you, but to me this sounds like a no-brainer. Lithium demand is going to skyrocket. There's not enough supply. And I want to talk about today's video sponsor, that's FE Battery Metals, and they're going to take a huge advantage of the situation. So FE Battery Metals Corp, that's ticker FEMFF. This company is poised to excel in the booming lithium market, playing a crucial role in powering electric vehicles and driving forward the renewable energy revolution. So I'll go ahead and bring up this chart here. We can see this stock is severely undervalued right now, and FE Battery Metals Corp is a publicly traded company listed on the OTCQB as, like I said, FEMFF. What makes this company stand out is its strategic focus on high quality lithium projects located in premier lithium districts in Ontario and Quebec, both renowned as a top-tier mining jurisdiction. So let's dive into why this opportunity is worth considering. So first is their excessive land holdings. We all know about real estate, location, location, location. Well, it's the same with mining. So FE Battery Metals Corp boasts one of the largest land portfolios in Quebec, spanning over 60,000 acres in the emerging lithium district near Val d'Or. The crown jewel of their projects is the Augustus Lithium project, strategically positioned adjacent to the fully permitted North American lithium mine, sharing the same geologic formation. This prime location provides immediate access to essential infrastructure, including year-round road networks, railways, electricity, water, and access to a pool of local mining experts. Next is their successful exploration. So the company has achieved remarkable success in exploration endeavors. With over 10,000 meters of drilling at Augustus project, they've not only validated historical findings, but also expanded upon them. Multiple clusters of spodumene-bearing pegmatites have been unearthed, highlighting the immense potential of their project. Now, like any good company, you want them to do strategic partnerships, and this is something FE Battery Metals Corp is doing right now. So FE Battery Metals Corp has forged strategic partnerships, notably with Sayona Mining of Australia, which now holds 2 of their projects in pre-feasibility studies. The Abitibi hub, where the projects are located, is poised to become one of the most substantial and cost-effective sources of future lithium production. Now let's talk about their potential in the market. Now bring up some charts here of some other lithium miners and what has happened to their stocks when they've done a huge discovery. We've seen stocks go up 100, 200, 300, even 1,000 or 3,000% when they've found massive discoveries. discoveries. And with FE Metals Corp only having a market cap of 16 million and some of the other miners having market caps in the billions, so it's not impossible if they do find a substantial discovery, we see returns like we've seen with other mining companies. And remember, this is the hottest lithium mining region in the world, so it's very, very likely. And like what we're seeing again with other past companies' performance, we could see returns 200, 300, even 10x. Again, I'm not saying this is guaranteed. I'm only saying in the case they do find a big discovery, you could see massive returns. Now, when you invest in any company, you want to know the leadership has a proven track record. With FE Metals Corp, they certainly do. So this remarkable growth potential is underpinned by the company's exceptional exploration expertise by Mr. Jody Gibson, an exploration geologist with over 14 years of mineral exploration experience spanning from North America, Cordillera, from Alaska to Mexico. Now get this, in 2020, Mr. Gibson received the prestigious recognition of Yukon Prospector of the Year, a testament to his outstanding contributions to the mining industry, as well as CEO Gurminder Sangha, who has a wealth of experience in finance. So this company is guided by a dedicated team of professionals with a track record of success. So to put it simply, everyone, FEMFF is poised for substantial growth potential with a booming lithium market. With a robust portfolio of projects, strategic collaborations, and a seasoned management team, as demand for lithium continues its upward trajectory, considering this opportunity is a chance to be part of a promising future of sustainable energy and electric mobility. Now, of course, everyone, you need to do your own due diligence. All investment involves risk, and past performance is no guarantee of future performance. But everyone, what do you think about all of this? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.